and welcome to the Daily FX and IG Trading Summit. I just would like a couple of participants to put in the question box, to make sure that you can hear me okay. Just a couple of replies there to make sure that the audio is coming across.
Yes, Daniel, we can actually hear you. It's fine.
You can hear? Okay, terrific, excellent. Well, let's get underway then. As we've just been talking about earlier on, there's a few disclaimers we just need to get out of the way. Obviously, trading on leverage has its risks, and you can see those important disclaimers there. And here's another one. We just need to make sure that we cross off on some of that administration. And yeah, as mentioned, I have been with Daily FX for almost a year now. And previous to that, I started with a commercial bank here in Australia as a price maker, spot FX, options and forwards, and then moved across to the investment management side of financial markets and managed the currency exposure for a very large fund manager, and then also managed global bond funds, run long short equity strategies, and various other types of derivative type of funds as well. So that's my background, and today we're going to cross off on a couple of little interesting things, I think, because the world's going through a lot of change, and there's some things I think that if we focus on, it might be able to help our trading. And certainly the things that we're looking at the moment are obviously inflation and real rates and how that impacts markets, because that's, to me, this is the real driver. And what the Fed is doing is really feeding into all other parts of the financial markets. And some of the earlier speakers, and I thank Daniel and Thomas, my colleagues there, for some of their insights. And these are the themes, and correlations across markets go toward 1 and -1 in times of uncertainty, in times of volatility. And that's that race toward just trying to cover risk. And we're seeing that in the current environment, and we'll have a look at a couple of instances where we can clearly identify some of those correlations and what's going on. Headline CPI and core CPI, or there's different measures of a core, but we'll look at the differences between the two just briefly, because it's really important to understand where we've been, to understand where we're going, and particularly why decisions have been made and why central banks are doing what they're doing, because then if we have a context of history, then we can understand why they're making the decisions that they're making and what to expect from them going forward. That policy response we saw to the pandemic that provided a huge supply side impact. But then, of course, this has been impacted by the Ukraine war and the issues in China, of course, with rolling lockdowns through major centers, causing all sorts of disruption. And those sorts of themes feed into the real return in the US we're going to be focusing on today. And we'll have a quick look at some of the products that we can trade to try to identify opportunities, US dollar and the DXY index, and then we'll look at gold and Dow as well. But of course, as always, we're happy to have a discussion around this. If you have any questions throughout the presentation today, please feel free to put them up. If it's relative to where we are at that time, then I'll answer them then. Otherwise, we can get to them at the end of the presentation as well. So moving along here, the headline versus core. Now, lots of central banks around the world, they have different measures of what a core inflation is. I think everybody's familiar with headline inflation. It's just a basket of goods that a typical household in any jurisdiction would experience purchasing. And the purpose of a core is to take out volatility. So say in the US in particular, they look at X energy and food. And in a normal circumstance, that makes sense, because energy and food can be really volatile in price. And so you get a distortion of what underlying inflation is when you have this volatility in food and energy. But the problem at the moment is that that measure may not be a good measure, because when we have a regime change, and this is what we're going through at the moment, where we have this huge supply chain shock, we have a war breaking out, and now those prices of all those goods have gone higher. Now they may well come back at some stage, but it's hard once inflation becomes entrenched for those goods and services to fully come back down. So, and it may not come down for a while as well. So that's where there's an issue with core measure. Other central banks use different types of variations of core. The Australian experience is that they use a trimmed mean, so that takes out the top 12.5 price rises over the period, and also the bottom 12.5. So it doesn't depend on what has been the most volatile items in the basket. It's just the top 12.5 and bottom 12.5 to get taken out. So that might reflect a little bit more what that is trying to achieve, and that's trying to look through short-term volatility in price changes, but also get an idea of what's going on in inflation. So this gets around toward an asymmetric bias, which we're going to go through, and then what is the shift as a result of what's happening now. And then at the end, as I said, we'll go through a couple of asset classes and try to identify a few opportunities. And so the inflation measures, we're just going to look at the US. I think it's just easier to understand because I think everyone's sort of focused on that at the moment. And it makes sense because it is a, sorry, there's a bit of a typo there that Bloomberg, the source was from Bloomberg, but the typo is just done something a little bit funny there. And 9.1% headline inflation, that is eye-watering, and it's really problematic, and I think everyone's familiar with that. And high inflation is detrimental to wealth. It destroys wealth over time. So high inflation is really bad, but what's even worse than high inflation is entrenched inflation and inflation expectations. And that's what the fight is all about on at the moment from central banks. They're really focusing on trying to get that heat out of the market, even though we know that these increases in particularly, say, oil, which we'll look at a little bit later on as well, they're probably going to roll off at some stage, but the problem is that they may not roll off in time. And there's a base effect in inflation calculations, and the Fed tried to use that last year, and then they pivoted away from a base effect to describe the high and rising inflation to transitory in nature, and of course that was wrong, and they've even admitted as much. So this concept of entrenched inflation is really dangerous for an economy. As I mentioned, that preferred measure is that core. It's at 5.9. That's lower, but that excludes food and energy, but it's still at 5.9. So that's really problematic. And 2% is the target. I mean, that's sort of roughly 2%. So they're a long way from their target. How do they get back down to 2%? Well, we know that they're jacking rates, and they're going to continue to jack rates. I think that Fed Chair Powell during the week, he described a stepping back from such hawkish rhetoric. And I think the market may have overinterpreted some of his remarks because he took away guidance, where it's previously in the previous FOMC meeting, they gave a guidance of 75 basis points at the next meeting. This time they didn't give any guidance for such a move, but that's not to say that it's ruled out. It's just that they've stepped back away from providing that guidance. So I think the market may have overcooked that interpretation, and we'll wait and see because time will tell. Now, the break-evens are something we are going to have a really good look at because that's important to take into our calculations about what's going on in the world, and that will also feed into real yields, which I'm sure most of you are probably familiar with. If not, we'll go through a quick little description there as well. So I just used the Australian measure before. That's the trim mean, but the US ex food and energy, but the Fed looks at the PCE core deflator as well. They're the key sort of indicators that the Fed likes to look at. And obviously that flows through into growth. We talked about inflation already, the policy responses, and then, the commodities and services and all the things that we've already mentioned before. So we'll just keep moving through that one. Treasury yields, this is where really, the market has been driven by what's going on in Treasury yields. And that's why I think it's appropriate to be looking at the US experience because as Daniel in the previous presentation mentioned before about those markets moving in sort of lockstep in some respects. So US Treasury yields were back above where they were before the pandemic. You can see that the chart dipped down in early 2020. We're back above there now, and a lot of that is around those inflation expectations and what's going on there. So there were problems within the financial system, particularly in the US before the pandemic, and that was reflected in the size of the Fed's balance sheet and their attempt to stimulate the economy there. So there were already a few issues before the pandemic happened. And of course, we know the policy response once the pandemic took hold, and it may have been appropriate. History will look back and judge the response and maybe have a bit more measured sort of view of whether it was appropriate or not. But nonetheless, there was a huge amount of stimulus and it got the world, well, toward a better place. It remains to be seen if it was the right response or not, but history will be the ultimate arbiter there. So I just left that GDP there. This is the Volcker Solution. So the reason why banks have this idea of stimulating and trying to keep the economy going is it's a twofold aspect. And the key here is that you risk inflation or do you risk losing growth? And here we're looking at inflation in the US, and the reason why this is called the Volcker Solution. Paul Volcker was the chair of the Fed at the time. He had the support of both the Carter and Reagan administrations. And in the US, inflation, as you can see in this chart here, was roaring high. It's higher than where it is today even. So there was an oil shock and a whole bunch of other factors that led to the inflation problem that they had. And then you can see in the early 80s how inflation was able to be reined in. And what Paul Volcker did was to tighten monetary policy aggressively, not just through rates, but through other mechanisms as well, in order to knock the inflation out of the economy. And high inflation, as I mentioned before, is really detrimental to the wealth of that economy. So it's really important to get rid of inflation, and price stability is a key component to lifting productivity levels within an economy. So getting rid of high inflation is really important. And what's happened in that episode there in the late 70s and early 80s, Paul Volcker came up with that solution. You just have to tighten really aggressively, really hard, and get spending back under control, get inflation expectations under control, bring down those price pressures, and then inflation can be manageable. And the problem is, though, the cost of those policy responses is a recession. And in the early 80s, you can see here, that red line going across is the zero line of GDP. So that orange line is GDP. And you can see in the early 1980s that there were 2 recessions. And so that's the cost of this type of policy. And at the moment, there's a lot of talk around inflation risk versus recession risk. The US has never brought inflation down by 2% or more without a recession. So here we have, before we looked at 9.1% headline inflation, the target's 2%. At 7.1%, they need to get rid of it out of the system. And to not have a recession would be a really, really skillful landing for the economy. But it's really hard to see, because this is the policy response. This is why central banks pump the economy with so much liquidity and such a loose policy. And it wasn't just monetary policy, fiscal policy was loose as well. But they're prepared to take this risk because high inflation, you can get rid of it. It will cost you a recession, maybe 2 recessions, but it can be dealt with. Whereas the problem with not stoking growth, which was the Japan experience, is that it's really hard to ignite growth once it's gone. And that's the risk that central bankers and policymakers globally are prepared to take. They'll risk that high inflation in order to maintain some level of growth. And so you can see here, this is the Nikkei from Japan. It's just a sort of representation of their sort of economic circumstance. And you can see that in the late 1980s, where the price was, and we've never retained that level in the Nikkei. So what that tells us was the policy response in Japan in the 90s and then into the 2000s wasn't enough. And initially it was called the lost decade, and then it became the lost decades. Now, there are a lot of demographic issues for Japan to face, particularly around aging and immigration, and that hampers their ability to stoke economic activity. So it's not just the policy response. There were other mitigating factors that have undermined that economic recovery for Japan, but nonetheless, there are numerous studies. You can go online and read, but the result was that there wasn't enough stimulation quick enough. And so that's what central bankers now and policymakers, as I said, they're happy to risk that high inflation because they know that they can get rid of it. Trying to get growth back, once growth is gone, it's very difficult. So that's why they risk that policy response, risk that high inflation, because it's manageable. It will cost a recession, maybe 2 recessions, but that's not the end of the world. That's only 1 or 2 years tops of tough economic circumstances rather than lost decades. So that's why central bankers do what they do. So let's have a look at the 10-year nominal yield and the break-even inflation, because this is what's really driving a lot of markets in my mind anyway. I'm just using the 10-year because that's the benchmark that a lot of people like to look at, and it does make sense, although other 10 years do provide value as well, but we won't go into those today. So the red line is obviously just the nominal 10-year nominal yield, and you can see what's happening there just in the last week or so, particularly US yields have really come off, and we saw that on that chart earlier on. And at the same time, inflation expectations have actually just ticked up a little bit, and that was on the basis of the Fed not hiking as aggressively as previously thought. So that led to inflation expectations in the 10-year break-even rate here. It's showing that little tick up just at the end there on the far right-hand side. And that's what happened just this week. So you can see that sort of broader picture between what's happening with inflation and yields and nominal yields. So that's what's going on. This break-even inflation, for people maybe not familiar with it, this is a market-priced inflation rate. So the TIPS, Treasury inflation protected securities, are traded in the US across various tenors. So and so it's a market price mechanism to tell us what the market is thinking about inflation further into the future. So it can be a worthwhile gauge to sort of track. And here we have the real rate, and the real rate is something we're going to focus on a little bit from now on, because it's really driving a lot of things. And the real rate is simply the nominal yield minus the break-even inflation rate. So that's the real return. 10-year real rate, you can see how it's dipped there, and that also, you know, the US dollar's been dipping at the same time, so it's driving a lot of markets. What's happening in the real yield is really impacting quite broadly. So it's important to understand these components feeding into the real yield. So the break-even inflation, the nominal yield, and then how that impacts the real yield, and that's what's driving a lot of markets at the moment. And that's why trying to get a handle on inflation expectations and what the Fed is doing and how that impacts yields is really important, certainly for my trading, and I would really recommend you know, a significant focus on that. I'm sure a lot of you already are, and that's where we are now. So there I've got inflation. That's at 9.1%, and that's the real yield. So you can see that correlation there, particularly in the last little episode there. So we're getting that uptick in inflation, we're getting an uptick in the real yield, and that's where, you know, there's a bit of a problem here for some markets anyway, with that high inflation creates all sorts of issues. So one area, we're talking about inflation here, I just want to touch on this now because I think this is an interesting one. This is obviously the crude oil price, and you can see after the Russian invasion, the impact on price, which I'm sure we're all familiar with the price going well above $100. But what's interesting here for me is this backwardation. And so here in this backwardation, you can see it was already high before that Russian invasion. And what backwardation is the futures contract, which is going to settle next, minus the futures contract that will settle just after that. Some people look at different time structures to look at backwardation, but that's just an immediate one that's simple and easy to understand. And a higher backwardation rate, what that tells us is that buyers want to take delivery sooner rather than later, because there's a perception around risk of trying to take delivery later on. So it makes sense that when backwardation starts rising, that the price of the underlying asset will also start rising. So that's what we're seeing here. And what I think is really interesting here is just that in the last week, backwardation has actually just dropped down a little bit, and the price has actually just, you know, ticked up a little bit. So to me, that's a bit of an issue to keep an eye on, because something's not right there. Either backwardation should be a little bit ticking up a little bit higher again, or the price might be looking to break a bit lower as well. But anyway, that's something to keep an eye on, because clearly energy is feeding into inflation, and that's what is really driving markets at the moment. Another little component here is the volatility. This is the oil volatility. I know my colleague just before spoke about the VIX, which is on the S&P 500, a measure of volatility there. This is a similar type of instrument. It's actually by the CBOE as well, Chicago Board of the Futures Exchange there. And so the OVX, that's pretty benign. So that's telling us a couple of things. It's saying that the market is actually pretty comfortable with where oil is trading at the moment, and so it's not a big concern there. So this is something to keep an eye on, backwardation and how that feeds into oil and how that feeds into inflation. So energy obviously is a huge contributing factor into inflation at the moment, because of those issues around the war and what's happening with Russia and them turning off the Nord Stream 1 pipe to Germany. So here's the real yield. I mean, you can see that correlation there, and this is why I'd like to focus on the real yield, because the way that it plays out into lots of different markets is really quite significant. And you can see that correlation. I mean, you know, especially in the last sort of really since the beginning of probably around February and March this year, what the real yield is doing and what the US dollar is doing is moving toward that correlation of 1. It's moving in the same direction. So keeping an eye on real yields and what inflation expectations are, and what the Fed is doing is really driving the US dollar. I don't think that comes as a surprise to too many people, but here you've got it clearly laid out for you. You can see exactly what's going on. And so monitoring what's going on in Treasury markets, what's going on with the Fed, is really going to feed into, particularly around anything that you trade against the US dollar, whether it be euro or dollar yen or sterling or Aussie or dollar Sing. What's happening with real yields into the US dollar is really going to be a key component to decision making around trading, in my opinion anyway. And here's just a price setup, something to keep in mind. What I find interesting here is that the trend is still intact. We've got a high dollar, it's still moving up. I've got a lot of moving averages here. I like to use moving averages. For me, they help to identify the underlying trend, and lots of other sort of reasons for that. I noticed earlier on there were a few questions around moving averages in the previous session. I tend to use Fibonacci moving averages because for me a moving average is representative of a cyclical part of the market. So a 21-day is actually a 1 month. So a lot of people use a 20-day, and that's fine. People can use whatever you like. And I noticed a couple of questions earlier on about a exponential moving average rather than a simple moving average. For me, I like the cyclical nature. So the 21-day for me is a 1 month. That's the average over a month. The 10 days, a 2 week, a fortnight. And so that's why I tend to prefer simple moving averages rather than exponential moving averages. But that's just part of that cyclical nature, which I'm trying to tap into using these moving averages here. But what that tells us at the moment is that the short-term momentum may have just gone out of the sales, and you can see that in the price anyway. But we've got 10-day crossing down below the 21-day. So that's just a short-term cross, a death cross, otherwise referred to, and that's just popped down there. One thing that I find interesting in this chart here is the October 2002 high. It eclipsed it by a little bit, but it was unable to close above that high. So for me, that's a potential rejection of that high. And then the next day, we had a engulfing candlestick. If you can look at the top of the chart there, you'll be able to see that. You can see that engulfing candlestick. So we had a rejection of the high there. We had the engulfing candlestick, and then of course the prices moved a bit lower. So there is a pause, and we're in the middle of that pause. It comes back to what we think about the Fed. It comes back to inflation expectations. And as I said before, I think the market may have overinterpreted and over-extrapolated the good news in the bad news this week. Not only did we have Fed Chair Powell talking about not giving guidance on future rate hikes, but also the US GDP number was a negative number, which is the second negative number in a row. Most parts of the world, 2 negative numbers is a recession, but in the US they use a different measure of what is a true recession, so they don't regard that as a recession. Nonetheless, there's negative growth there at a time where interest rates are going up and they're going higher and higher and higher. And we'll get into the Dow a little bit later on. But the point there is all around that, what happened this week in particular from the Fed and from the GDP number, and how that's sort of feeding through into prices. So if we move along, now this is really interesting. A lot of people like to trade gold, and the key component for me in gold is the real yield. A lot of people look at inflation and they like to say that's an inflation hedge, but you'd be disappointed if you had gold as an inflation hedge over the last 2 years, because gold really rallied on the safe haven sort of component initially, but then once we got inflation really running away, so in the middle of this year particularly, and even right now, as we saw, 9.1% is where inflation is now. So gold has pulled back a long way from its high from March. But nonetheless, what's happening here, you can see that inverse correlation here. And once again, that correlation, -1 correlation, a US 10-year real yield is falling, gold's going up. There's no return for holding a long gold position, but of course it's in comparison to what are the other investment options out there. And when the real yield is moving down, you tend to get some support for the gold price anyway. So once again, this comes back to understanding what the Fed is doing, what inflation is doing in the US is really important to how we make decisions with other sort of markets and what's going on. And it's just something that we need to always be cognizant of. And here we are putting a few of these together now. So that nominal yield and then the US dollar index, you can see these correlations. It's all sort of stacking up. It all looks like the same trade. And I think that ultimately, when you're in these times of uncertainty, you do end up with a lot of this. It's almost the same trade. It's not the same trade, obviously, you're trading a different instrument, but it does look like it. And you can see that here. And it becomes pretty obvious that whatever is happening with the US dollar is going to be driving a lot of markets. And what's driving the US dollar? Real yields, driving real yields, inflation, and the Fed. So that's why this is a really important component to make sure that we're focused on. And just looking at the long-term chart, this is a weekly, going back for just a couple of years, just to sort of get a broader picture on what's going on with the gold price, because it's an interesting one here that we made that double peak, and the double top is can be a signal in technical trading. I'm sure some of you will be familiar with it. And if you look at the long-term chart here, it looks like a double top there. So that's a bit of a worry for the overall sort of perspective around gold. If we've got rising real yields, that's going to be a problem too. The last sort of week or so, obviously it's gone the other way, but the bigger picture is if we've got rising real yields and we've got this sort of broader picture of what's going on with the gold price, then that's something to keep an eye on too. And this is a bit of a shorter term sort of perspective here. And at the top there, you can see the August 22 all-time highs at 2075, whereas sort of in March this year, we only got up to 2070. So we couldn't even eclipse that previous high. So that confirms that double top, and that's a bit of a signal potentially. So the broader picture here, since we made that peak in early this year, there's that trend channel. It's still intact despite this rally. And there's a couple of trend lines. It's threatening to get back up toward that trend line up there. And it'll be interesting to see if it can get through these breakpoints, which are just above the price there, sort of between 1780 and sort of 1800. There's a few resistance levels there. So that'll be an interesting price action there. If it does get above there, then there might be a bit more support for gold. But if it stays below there, then that's a bit of a pivotal point that I'm keeping an eye on, because that might be a bit of a driver, and obviously keeping in mind whatever else is going on with the Fed and all that kind of thing. And once again, you can look at that 10-day moving average. It's still well below the 21-day at the moment, but if that crosses over as well, that may confirm a bit of maybe a pause in this a pause in the bearishness around the gold price. But these are the things to watch out for that I'm certainly focused on anyway for gold, because if we get above 1800, then that might tell us that it'll tell us about the gold price mostly, but also the US dollar and what's going on there. So that's just something to keep an eye on. We're going to talk about the Dow now for a little while, because what we're talking about, inflation, is really important for equity prices. And in particular, that's the real yield. You can see that correlation there again, just in the last week, real yields go down, the Dow Jones goes up. So that's an inverse relationship that we can clearly identify there, and something obviously that the market is focused on. And that's a bit of a reversal from what had been going on for the last sort of month or two. So that's what's unfolding there. A key component for equity prices is that inflation gauge, and in particular for equities, there's a real problem at the moment, and the problem is the PPI, which is the input cost that companies face, whether at the farm gate or at the factory gate. They've got higher input prices. Now, when companies have higher input prices, they've got two options. One of them is that they can pass on those increases in input costs, and that leads to higher CPI. So if PPI is up around 10% at the moment in the US, so if that remains high, companies have that choice. They can either pass that on in higher prices, or they face margin compression and they take the loss themselves, or take a less of a margin for their profitability. So if they take that second option and they face margin compression because they've got higher input costs, then that's undermining earnings, and that's a problem, obviously. And so while earnings are holding up at the moment, and we've seen some good numbers this week from various sectors, particularly in the US, so earnings are holding up now, but looking forward, this is a problem, because if they pass on the costs to consumers, CPI will continue to rise. And if CPI continues to rise, the Fed will be forced to maintain aggressive hiking to get inflation out of the system for all the reasons that we talked about earlier. So this is where the problem is for equities, in my opinion anyway, because with higher input costs, you either have margin compression, which undermines earnings, which undermines the stock price, or you pass on those higher input costs and CPI continues to accelerate or remain at high levels that will force the Fed to raise rates just as aggressively as they have in the past. So that's the problem that I'm seeing around equity prices, in my opinion, because either scenario doesn't work out well for earnings and for equity indices, in my opinion, because ultimately the inflation picture may change, but it's that PPI which I don't think many people are focused on. And if you focus on PPI, then you get a really good handle on what these companies are facing. And so keeping an eye on PPI is, I think, a really key component to understanding what is going to be happening for company earnings and for inflation gauges further down the track. And this is well known for people who have done sort of econometric modeling. PPI, it comes down the pipe. So it's still coming down the pipe. And that's a problem. And that's where equities are potentially could face a few hurdles. So something to keep in mind, that whole inflation picture that I drew a little bit earlier on, PPI is now the key component, in my opinion, to work out how inflation is going to unfold and how companies are going to deal with these higher input costs. And not many people, I don't think, are really focusing on that too much. And have a look at the price setup here. My colleague earlier on mentioned the VIX, and look at that, when the VIX dips down, the Dow Jones managed to rally a little bit there. So that makes sense, as he was talking about before, part of a portfolio and trading that. Another signal that I like to look at, or another sort of technical analysis tool, is the Bollinger Band. And once again, this is the 21-day Bollinger Band. This is invented by John Bollinger. And essentially, it's a volatility measure. So volatility as part of risk management is a really important component of trading. And I'm sure many of you are probably reading up on risk management. And Daniel mentioned about the need to be consistent in your trading. And a key component of being consistent in your risk management is monitoring volatility as well. So for me, volatility is a key component of understanding how much risk to put on or not to put on. And here we have the Bollinger Band, and as they widen, we're getting high volatility. But also what's happening here is the price is moving outside of that Bollinger Band. And what can be an indicator of a reversal, it doesn't always work, like a lot of technical signals. Some of them work some of the time, but not all the time. If we get a close outside of that Bollinger Band and then a close back inside the Bollinger Band, that could tell us that the market has exhausted volatility to that side. In this instance, it's on the top side. So it's outside the close this morning in APAC time, which was obviously the close in New York. It's closed outside the Bollinger Band. So for me, I'm keeping a very close eye on when that closes back inside the band, because that might be the opportunity to look for a reversal there. Just having a look, there's a couple of questions coming through. Just see if some of them are relative. I'll tell you what, I'll keep going, and then at the end, because I'm not far from finishing the formal part of the presentation, and then I'll come back to those questions. So this actually goes to the scenario. So now we've got the status quo remains, inflation remains high, the Fed maintains their tightening bias, and this is the hard component, is when does the Fed unwind or become less aggressive in their tightening, and that's the hardest part. I think for the next 2 or 3 months, they've said that they're going to maintain this tightening bias and making sure that they try to get inflation under control. Treasury Secretary Janet Yellen this week also came out, and she said that getting inflation under control was the top priority for the administration, White House. So this is a universal problem for the US. It's not just for the Fed, it's also for the government there. So getting inflation under control is the focus, and that means that a recession it seems unlikely that they won't get a recession there. So of course, inflation could easily turn around if we get these supply chain blockages cleared. Unfortunately, the Ukraine war doesn't look so great in terms of coming to a resolution very soon. And I don't think that China are prepared to back away from their zero-case COVID-19 policy at this stage. And in fact, even when there were hopes about 2 weeks ago for such a move, they're quickly quashed. So I can't see that policy changing, and that means that unfortunately a lot of those major ports and major cities are going to face those lockdowns, which of course crimps economic activity, and the rest of the world will feel those impacts as well. So that's the problem there. So we'll just move along now. So that's the end of what I was going to sort of present for today. But we do have a couple of questions here, so I'll just have a look through here. Okay, so one of the questions is around the US dollar here. And so I'll just go back to that chart because that might be relevant to what we're talking about here. Why is the USD strengthening with all the tremendous quantity of dollars in circulation? Shouldn't the value depreciate? That's a good question. I think that the bigger picture for the US dollar is around not so much dollars in circulation, but around perceived value. And this is a interesting concept around what is value, because dollars in circulation impacts money supply, and velocity of money supply is particularly something that is really important in terms of monitoring economic activity and stimulating economic activity. But in terms of the amount in circulation and the value of a dollar and the value of any currency, it's a fiat currency. So fiat meaning that let it be. So once we let go of the gold standard in the early 1970s, currency was no longer tied to any actual asset. It was only tied really to its citizens and the belief that the citizens would be able to pay the bills through tax receipts. So the value of any currency is only really backed by tax receipts within that country. So really a US dollar and the value of the US dollar is all about perception. So in terms of strengthening or depreciating, it's all about what's going on. Is it a worthwhile return? And as we've covered off quite a lot earlier on in the presentation, the value of the US dollar is really being driven by real yields, which has been driven by inflation, and what the Fed is doing. So in terms of identifying the appropriate level of what the US dollar should be doing, I think that's the focus, is to look at what else is going on. And there's a famous Keynes quote about, it doesn't matter so what you think is going on in the market, it's what the market thinks is going on, because you can be right, but you could lose all your money before you're proven right. So that's the US dollar there. 10-day, so I've been asked about a moving average here. Yeah, look, as I mentioned before, the 10-day is something I like to use just because it's a representative of a 2-week time period. So in that regard, we can keep an eye on sort of what's happening over that fortnight and where's the average price for that fortnight. So that's why I use a 10-day. Some people do use a 9-day. I've seen that quite a few traders use that, but I prefer the 10-day for all those reasons, just because it's a 2-week representative 2-week. And so if there's any more questions, I'd certainly welcome them. And I could certainly talk about other markets if somebody has a question about other markets, because there's a lot going on at the moment. And getting a question about the VIX here. Okay, so 23 has a good correlation, yeah, with the S&P 500, absolutely, yeah. Crude oil volatility that we could read. Okay, that's a good question. So the question is asking here, is there any level of crude oil volatility that we could read as being correlated to stock level or any other market? Potentially. Let's have a look at that backwardation, because I do focus on this when I'm trading oil. And so volatility as that component. And you can see, well, I mean, it makes sense. And I know that Daniel, my colleague earlier on, he was talking about how there's an asymmetric view around the VIX as well. So stock prices, when they tend to fall quite quickly, and then they tend to rally not as quickly, as a very broad generalization. But nonetheless, that's where you get the tick up in volatility, because of that sharp price movement. And that's where VIX has that value as a hedge against the downside, particularly. In terms of the oil market, it's mainly when you get those shocks to the system. And in fact, you can just see on the far left of that chart, unfortunately, I didn't include it because it does distort the picture there. But that huge issue that we had in 2020, at the beginning of the pandemic, when the oil price went to negative. And so that was when that was on the downside, and so you can see the OVX in the far left corner is actually higher than where it is today, and that would make sense because the prices were so dramatically crushed, and that was really related to storage capacity because the oil contracts that are traded in the US are deliverable. So if you are long and it comes to expiry, you actually have to take delivery of the oil, and so if you don't have facilities to take delivery, then that causes a problem. And of course there was problems where all the facilities were full because of the slowdown and people weren't using as much oil. So that caused that problem where there just weren't enough storage facilities, and that sent the oil price into negative. But the point there is about the level of volatility and the OVX, how high it was, and that was up to sort of, it's above 40 there. I think it got up to 50 or something like that. And so now we're back down here. And then, but when we look at the Russian invasion, we saw a tick up in the oil volatility in the OVX at the same time when the price went up. So it's a good question. It probably has less validity in terms of being a good hedge in either direction for oil versus the VIX for equity prices. And using the VIX for hedging equity prices, a long equity portfolio in particular is a pretty common strategy, but it does have a cost of carry, so you need to get your timing right for that sort of strategy. But yeah, I would definitely say the OVX is less valuable as a hedging tool for that. But it is valuable just to sort of get a gauge of where the oil market is and how it's and how it is moving. I'll get another question here. The 2-year US dollar index. Okay, so would you explain how you would arrive at a 10-year real rate? Yeah, absolutely. So we'll go back up there. So we can have a look at this. And so here I'll go back to the beginning. So that's good. We'll get past that. Okay. So that's the nominal yield there. So this is the 10-year that we're looking at. The real rate we're trying to determine. The nominal yield, you can see, if you can see that on the far right side, so red line 2.65 is the current 10-year yield on the Treasury there, and the break-even inflation rate through price through tips is at 2.53. So it's a variation of 12 if we minus the inflation expectation and market price inflation expectation. 2.53, 2.65 minus 2.53 will give us that 0.12. So that's how we end up with the real rate. And I hope that answers your question, but that's, yeah, and the real rates are really driving a lot of things at the moment, so it's really important. The 2-year, there's a question, the market seems to be moved by the 2-year USD index recently. I think you're referring to the 2-year Treasury, maybe, I think is what the question is referring to. And absolutely, short ends are particularly sensitive, particularly with the Fed moving rates so aggressively. There is a much bigger focus on the short end. And if we go back up here to that Treasury yields that we have across all the, so you can see here, so that blue line is the 1 year, and then the 2 year is that orange line. What's interesting there is that there's not I mean, if you take out the sort of 20 and 30 year, that's the 20 year is the 3.22. So if you ignore that, then 2.65 to 3%. So that's only 35 basis points between a 1 year and the 20 year, a 1 year and a sort of 10 year, yields. That's pretty narrow. A yield curve typically would be steeper than that in a normal circumstance, and so it's not very steep, that yield curve, and that's also a potential indicator of a recession. So the 10 year is the pink line, which is a bit hard to read there, but it's actually below all the others. So 10 years at 2.65%. So the 10 years below the 1, 2, 5, 7 years. So that is often seen as a potential indicator of a slowdown in the economy and a potential recession. So you may have heard people talk about a curve inversion, and that's what that refers to. When the yield, in this case, in the 10 year, is below, say, the 2 year. The 2 10s is the most common yield spread that we talk about in fixed interest. And but there's a lot of other curves a lot of people focus on, and particularly so the 3 months, 10 years, or the 3 month, 5 years. All these curves are really important, and people like to look at them and work out, try to see what's going to happen within the broader economy to get a handle on that. And so I'll just have a look here. Got a few more other questions here. And the correlations between dollar yen and euro. That's a really good question, actually, and this is something I've been focusing on this week particularly. The euro's caught in a bit of a range. It hasn't really broken out of that range. So it's a strange phenomenon there. But what that tells us is that the problem with the Ukraine war is obviously having an impact, and it's having a much bigger impact than than they would like, obviously. But what's that saying in this period where the US dollar, say going into the end of the week here, where the US dollar was really weakening and every other currency was really strengthening, the euro failed to break above previous highs. So that's telling us something as well. And and I touched on earlier on, when you get a failure to move, and particularly in global macro, you're looking for these breakpoints, and why, in a broader context, something's moving and you would expect that other asset class to move in a similar fashion, and it doesn't. And I think for the euro, this is a good example where the US dollar has really weakened a lot in the last 3 days of this week, and the euro is still stuck within a range. It's in a sort of a 101, 102.70 type of range. So that's telling you something. Or I think the market is trying to tell us something there about the euro. So the euro too is in a downtrend. It's got a trend channel. It's negative sloping. So that's telling you something as well. But then you look at, say, dollar yen, and dollar yen has obviously snapped back this week with that US dollar weakness, but it's actually moved a lot more aggressively than what it had against the euro. And so that's a bit of a interesting dynamic, I think, with dollar yen in particular, because dollar yen has been, as I'm sure everyone's aware, on a very significant upward trajectory for quite a while. It's making a 20-year high, 22-year, 24-year high, I think it is now, or it did in sort of in July, early in July, 2 weeks ago, so around the 14th or 15th, I think it was. And then we just completely capitulated to the downside on Friday, in Friday's session, and on Thursday. So that's it's an interesting crossroads, and once again, it comes back to what the market has interpreted about what the Fed is doing. And so the Fed is, they have said that they won't give guidance, but I'm not sure about have they really stepped away from their aggressive tightening cycle. So that's just something to keep in mind. US dollar is still significantly higher than where it was, a few months ago, particularly in dollar yen I'm talking about here, and even a lot of the other currencies. So that's something to keep an eye on, that's for sure. Okay, now another question about the euro here. What level would you short the euro? Well, I mean, that's a good question. And so we're in this range that I mentioned before, 101 to 102.70 roughly is the range at the moment. So for me, that's if you're into range trading, there's parameters there. If you break the range, then you get out of your position, manage your risk. And I'll just emphasize how important risk management is. But on the top side, that 102.70 is a bit of what we call free air above that. So if it does break above 102.70, it could get up toward 103.5, without too much resistance there. There's a big breakdown that occurred in euro earlier in July. It was like in the first week of July, I think it was. And so there's quite a big gap between the price action there. In fact, I think it collapsed. It's about 2%, 1.5%, I think it was on the early in July anyway. And so it set up a series of levels between 103.40 and 103.60. And if it gets above 103.60 and consistently stays above that, then that will tell us something about the trend. As I said, it's still within a descending trend channel. But if it does get above that 103.60 zone, I think that could be interesting, and it might be telling us, the market might be telling us something if it gets above there. So that's, to me, the break point on euro. If it gets above 103.60, something has changed. As long as we stay below that, that means that the descending trend channel is still intact. So trying to get a level to short there, it's a tricky one, because that near-term high 102.70 is, as I said, there's a lot of clean air above it. So if it does break, it could run for a little bit, and you need to have your stop loss in place to ensure that you don't get sort of too caught up in that. And any other questions? Other questions here? Okay, I've got one on the Aussie, and I know that I did hear Daniel. He also talked about the Aussie for a little bit, and clearly the Aussie against the US in particular is very sensitive to what's going on in the world, and obviously China is a significant component of that. And so if we look at the Aussie and think about iron ore prices in particular, they've come off a lot in the last 3 months or so. So let's just talk about iron ore here. I know Thomas also spoke about metals earlier on. One thing about the exports that Australia in particular sell a lot of, obviously iron ore is the #1 export, but they are long-term contracts. So they can range from 3 months to 10 or 15-year contracts. So the short-term spot price in the iron ore is not as crucial as a lot of people would, a lot of market commentators think that it's a direct correlation between how much Aussie needs to be bought or not bought as a result of the iron ore price. But as I said, they're very long-term contracts. So what I think iron ore does, though, it reveals a sentiment around China's growth prospects. So that's where the indicator really is. It's not in the price itself. It's not about saying Australian exporters are going to be much better or much worse off as a result of the spot price in iron ore. Two main futures contracts that we look at. The Singapore Exchange has got an iron ore contract. I'm sure many of listeners in that part of the world would be familiar with the Singapore Exchange and their iron ore contract, and obviously the Dalian Commodities Exchange, which is in China itself. So they're the two big futures exchanges, but the volume that they do on those futures exchanges is very little compared to what is actually traded in the bulk commodity contracts that go between these two, the exporters and the steel makers up in China. So, but once again, it is about sentiment, and we're talking about the US dollar before about what's the valuation of it, and really it's about perception of value. And iron ore is a product that actually gets used clearly, whereas the value of it and the exchange of iron ore through the futures market and that mechanism doesn't necessarily reflect what's actually going on between the steel makers and the exporters of iron ore. The Australia's trade data will be out this week on Thursday. There was a huge number last month, so that's something that people are really keeping an eye on as well, because that also will tell us a lot more about how much iron ore is actually going to China, even though there's a lot of speculation about that slowdown, and particularly in property markets in China. That what really is undeniable is how much iron ore actually gets put on a ship and arrives in China. So if that trade data comes out and it's another big number, then that's probably telling us that despite the problems that are going on mainland China at the moment, there's still appetite. Or if it's a really bad number, then that might tell us that things have really slowed down. So and that's part of the indicator that the Aussie is for global growth and global sentiment. So if that trade number is significantly negative or doesn't hit expectations, then that will be telling us something about what's really going on, particularly in the growth engine that is China. So something to keep an eye on. That's on Thursday. Clearly the RBA are out on Tuesday for the Aussie. They'll be making a decision on rates where the market expects 50 basis point hike from them, and their inflation data was fairly benign last week compared to what was potentially going to happen. 6.1% is the Australian inflation rate at the moment. So the RBA are going to hike most likely, but it would seem, the market certainly thinks so, but they may not need to be as aggressive as they previously maybe thought they had to be. So some interesting developments this week. If there's no more questions, I'll just give you guys another minute or two and see how you're going. But certainly it's exciting times in markets. There's a lot of opportunities and a lot of movement, a lot of volatility. So once again, I really emphasize risk management to be a key component to good trading. And there's lots of resources on dailyfx.com as well as with IG, the IG Academy. So you can keep an eye on what's going on there. So